Guys, Zambezi is also an excellent question. It's a combination of PPE and cash flow statements, but it's an excellent PPE calculation. So please go and have a look at this. It's not a long question, but it's an excellent question, so make sure that you can do that. Ignore value added tax and dividend withholding tax. Zambezi Limited manufactures garden furniture, which they market to wholesalers throughout the country. The following balances were extracted from the company's financial statements for the years ended 31 July 2017 and 31 July 2016. Obviously, year end 31 July. Income tax payable, accrued expenses, accounts payable, allowance for credit losses. Ooh, don't forget this one. Let's mark that one so that we don't forget it. Accounts receivable, revenue, cost of sales, profit after tax for the year. Plant at cost, accumulated depreciation on the plant, long-term loan inventory, shareholders for dividends, and retained earnings at the end of the year. Additional information on transactions that took place during the current financial year. The accounting policy on depreciation in the 2016 financial statements stated that plant was written off at 15% per annum on the diminishing balance method. The Board of Directors decided to change the depreciation calculation from the current year onwards to the production unit method by applying the reallocation method. At this stage, the existing plant had no estimated residual value. Good, so the reallocation method says we have to look at the carrying value of the asset as at the beginning of the current financial year, and then we're going to apply the remaining lifetime or the remaining capacity in this case of the asset with the new estimates on that carrying value as at the beginning of the year. So if we look at plant we have at cost and we have accumulated depreciation. Now, because we're going to work with carrying value, do we have the carrying value? Yes, we do. It's the difference between those two figures as at the beginning of the year. Now they tell us that the plant consists of two components. Good. There was no estimated residual value in our new estimate. The total production capacity of the two components was considered to be 500 units, of which 280,000 units had been manufactured up to the beginning of the current financial year. One of these components, which had a carrying value of 350,000 Rand on 1 August 2016, was sold on 1 December 2016 at a profit of 45,000 Rand. The plant which was disposed of had a total capacity of 100,000 units, of which 60,000 units were manufactured up to the beginning of the year and 15,000 units were manufactured in the current financial year. The other component of plant manufactured, let's do that a different color. The other component manufactured 45,000 units in the 2017 financial year. All depreciation calculated for the year was correctly done on the production unit method. Now, the first thing that we have is we have two components. The second thing that we have is we've got total carrying value. And then they tell us that one of these components, which had a carrying value of 350,000 as at the beginning of the year, so the other one must have the difference. So if we start off with this question and we do it in a table format, we say we've got component 1 and component 2. We've sold component 2. The total carrying value at the beginning of the year was my 1350 less 135,000 Rand, which gives us 1215,000. They tell us the one that was sold had a carrying value of 350,000 in the beginning of the year. So that's 350,000. So obviously the difference between the two must be component 1's carrying value as at the beginning of the year. Then they tell us that the total production capacity of the two components was considered to be 500,000 units, of which 280,000 units had been manufactured up to 31 July 2016. Now, a capacity in total, 500,000. The one which was sold had a capacity of 100,000. So therefore, the other one had a capacity of 400,000. They said that this one, which had 100,000, 60,000 were manufactured up to 31 July. So 280,000 had been manufactured up to 31 July in total. And the one which was sold had 60,000 units, which was manufactured up to the beginning of the year. So already manufactured 60,000. In total, it was 280,000. So therefore, the difference of 220,000 belongs to component 1. So now we can work out the remaining capacity, because when we apply the reallocation method, it is the carrying value of the asset at the beginning of the year, less the estimated residual value, the new estimate, divided by the remaining capacity multiplied by the number of units in the current year. So the remaining capacity then is the 100,000 less the 60,000 and the 400,000 less the 220,000, which gives us 180,000. Now for the current year, they said that we have manufactured the other component 45,000 units. 15,000 was for the one which we have sold. So if we look there, 15,000 on the one sold, 45,000 for the other one. So what is our depreciation now? It will be our carry value as at the beginning of the year, 865,000. There's no residual value, divided by the remaining capacity, which is the 180,000, multiplied by the number of units in the current year, 45,000, and that will give us our depreciation on component 1 of 216,250. Component 2, we will say, well, the total carrying value was 350,000. The remaining capacity on component 2 in the beginning of the year was 40,000, so 350 divided by 40,000 multiplied by the number of units of this year, 15,000, and that will give us total depreciation of 131,250. So if I add the 131,250 and the 216,250, I will get my total depreciation for the year of 347,500. Now, the component which was sold, what was the carrying value of this component at the date of sale? Well, the carrying value at the beginning was 350,000, less the depreciation on that component for the year 131,250. That would have given us a carrying value of 218,750. The question tells us that we have made a profit of 45,000 Rand when we sold that component. So here's our profit on the disposal, 45,000. So the proceeds on the disposal, 263,750. So our investing activities, cash flow from investing activities, plant purchased, we don't know what that is as yet. But we do know that the proceeds on the disposal of the plant was 263,750, and that we do know. This is also wrong. It's 530,000 plus 263,750, so cash flow from investing activities, 266,250. Now we haven't done the 530,000 yet, so let's have a look at that calculation. Now for that we need a combined account once more, because we are only having the carrying values in this calculation that we've done. Now if you look at our opening balances, cash 1350, accumulated depreciation 135,000. So there's our cost 1350, accumulated depreciation 135,000. Our closing balances: cost 1.5 million, accumulated depreciation 321,250. So closing balance, there's the cost price 1.5 million, there's the accumulated depreciation 321,250. Our total depreciation charge for the year was 347,500. So total depreciation 347,500. The carrying value of the asset disposed of, there we worked that one out, 218,750. So here we're going to take it out, 218,750. And then our balancing figure in the plant account will be the new plant that we've acquired, 530,000, and that is plant purchase for replacement purposes, 530,000. Good. Now the question said we have to show cash flow from operating activities, and we have to follow the indirect method. So if we're going to follow the indirect method, we are going to start with profit before tax. The company tax rate is 28%, and it was applicable for both years. Great. There's nothing funny in this question. So that means if they gave us the profit after tax for the year, the 702,000, we're just going to gross that one up to a before tax figure. So when we get to our profit for the year, we just find it. Profit for the year before tax, 702,000 divided by 72%, which will give us 975,000. Then we're going to adjust it for non-cash items and separately disclosable items. We've already worked out our depreciation, that was 347,500, and we have that profit on the disposal of the plant. Profit on the plant, 45,000, which we're going to deduct. Interest paid is going to be on the loan account. Guys, I'm not going to work that one out. It's 12% per annum. You have to work it out on the outstanding balances. They tell you here the long-term loan and the interest was repaid at 31 July. So you're just purely going to work out what the interest on that was. It's not there. It's not there. And the interest there is 180,000 times 12%, which equals 21,600. Good, that one we have. Now, an important one that you do not have, that you mustn't forget, is that there was an increase in the allowance for credit losses account, and that increase must have gone through the income statement as an expense. So therefore, we have to add it back. So the difference between that allowance account balances, the 21,000, needs to be added back to your profit before tax. Inventory, accounts receivable, accrued expenses. It's part of our working capital. That difference, and accounts payable. That is then all our working capital changes, and that will give us cash generated from operations of 1,250,500. Then our separately disclosable items, again, our interest of 21,600, there was no accrued interest, and then tax paid and dividends paid. So let's have a look at our tax. Our opening balance was 22,500. Somewhere income tax payable, 22,500. Closing balance was 30,000 rand. 22,000 and 30,000. Your tax charge for the year equals then our profit before tax of 975,000 multiplied by 28%, which gives us 273,000. And then our balancing figure, which will be then the amount actually paid as tax, 265,500. Dividends paid. Now the question had something about shares. They've told us here that ordinary shares were issued and share issue costs amounting to 45,000 rand were paid. It is the entity's policy to write off share issue expenses against retained earnings. 100,000 ordinary shares were bought back from shareholders. Shareholders were paid an additional 80 cents per share over and above the amount that they originally invested. So that means there was a premium on the buyback of 100,000 times 80 cents, which is 80,000 Rand. And they did not have to tell you that premiums on redemptions needs to be played off against retained earnings. You should know that. Now, we have shareholders for dividends. Yeah. Different amounts. So that means there must have been a dividend declared during the year. So let's try, and they don't give me that dividend. So we have to go and find out what it was. But we have retained earnings. And we know that retained earnings, what does that affect? Profits after tax, dividends, which is going to make it less. In this case, there were the premium on the buyback and share issue costs, which have reduced that retained earnings. So the only thing, and we have profit after tax, so that we also have. So if we start recompiling, just put down everything that we have on retained earnings, you will see that the balancing figure should be then our dividends. Retained earnings in the beginning of the year, 600,000. Then profit after tax, they gave it to us, that was the 702,000. Then we had share issue expenses of 45,000. Share issue cost of 45,000. Then we had this premium on the buyback of the shares, 100,000 times 80 cents. That also reduced our retained earnings, 80,000. Our retained earnings at the end of the year was 500,000. So that means our balancing figure must have been our dividends, which we have declared during the year, 677,000. Shareholders for dividends. Opening balance, 280,000. Closing balance, 130,000. 280, 130. Dividends declared, 677. And then our balancing figure would be dividends paid of 827,000. Please go and have a look at everything that I've marked in yellow. That is very important. Make sure that you understand and can do these questions as the solution suggested.